Wall Street is bracing for a slowdown, but a handful of companies didn't get the memo. Despite rising interest rates, global uncertainty, and recession chatter, these 8 growth stocks are surging forward, each with 15% plus revenue growth and big institutional backing. One of them? It's innovating faster than Tesla in its early years. Let's dive into what analysts are calling the smartest growth plays of 2025. Let's start with a name that's dominating the AI semiconductor race, Broadcom, ticker AVGO. Broadcom is a major player in the semiconductor industry, known for designing and supplying analog and mixed-signal chips. What makes Broadcom stand out? Well, in fiscal 2024 alone, the company posted an eye-popping 43% revenue growth, and even more impressive, 46% growth in AI-related revenue. They aren't just meeting expectations, they're shattering them. Analysts expect Broadcom's AI chip sales to exceed a $20 billion run rate by July, and they're forecasting a jaw-dropping 60% annual growth rate in this segment through 2026. That's not just growth, that's dominance. Pros? Broadcom is at the center of the AI hardware boom and benefits from a diversified chip portfolio that feeds into multiple industries. The con? Chip makers often face cyclical risks, so investor sentiment can swing quickly. Broadcom's stock closed at $244.28 on June 9th, with a price target of $290. Still room to run? Possibly. Now, let's talk about a healthcare heavyweight that's capturing headlines with its blockbuster drugs, Eli Lilly, ticker LLY. Eli Lilly has become a pharmaceutical juggernaut, especially in the weight loss and diabetes space. In the first quarter alone, revenue shot up by 45%. But here's where it gets jaw-dropping. Mounjaro, their diabetes and weight loss drug, posted 113% revenue growth, and Zepbound surged by a staggering 346% year-over-year. Analysts believe this is just the beginning. With an aging population and surging demand for GLP-1 drugs, Eli Lilly is poised for continued momentum. Pros: a deep pipeline of treatments, massive demand, and strong pricing power. The cons? High valuations and potential regulatory risks if drug pricing reforms intensify. LLY stock closed at $773.58, with a CFRA price target of $973. That's some serious upside. Next up, let's switch gears to fintech and software. We're talking about Intuit, ticker INTU. If you've ever filed taxes or managed a budget, you've probably used one of Intuit's products. TurboTax, QuickBooks, or Credit Karma. They reported 15% overall revenue growth last quarter, with standout growth of 31% in Credit Karma and 19% in their business solutions segment. The secret sauce? AI. Intuit is integrating artificial intelligence across its ecosystem, helping boost conversion rates and increasing the uptake of premium services. Analysts project double-digit revenue gains through 2026. Pros? Sticky customer base, strong brand trust, and solid recurring revenue. Cons? Dependence on tax season and intense competition from newer fintech apps. Intuit closed at $764.38, with a price target of $823. But before we proceed, here's a question for you. With so much hype around artificial intelligence, do you think AI stocks are already overvalued? Or is this just the beginning of something massive? Comment your thoughts below. We'd love to see where you stand. Now let's talk about a company quietly transforming how businesses run behind the scenes. ServiceNow, ticker NOW. ServiceNow provides cloud-based platforms that streamline workflows, automate tasks, and keep enterprise operations humming. In the first quarter, revenue was up 18.5%, and net income rose by over 32%. Subscription revenue increased 19%, and large deals are rolling in, with a 20% increase in customers spending over $5 million annually. Pros? They have deep market penetration among Fortune 500 companies and high retention rates. Cons? The stock trades at a premium, so expectations are sky high. Now closed at $1,026.56, with an ambitious price target of $1,116. Let's move to a different kind of growth story: American Express, ticker AXP. This isn't your typical high-flying tech stock, but Amex has carved out a strong niche. With 7% revenue growth and 6% income growth in the first quarter, it may seem modest, but here's the twist. Amex targets premium customers, and they spend big. Analysts point out that the top 10% of earners drive nearly half of all credit card spending. American Express's ability to capture and retain these customers makes it more resilient during downturns. Pros? High-spending loyal user base and strong branding. Cons? Reliance on consumer sentiment and global travel trends. AXP closed at $301.55, with a $320 price target. Let's stay in the financial world for a moment and talk about Morgan Stanley, ticker MS. Morgan Stanley saw 17% revenue growth in the first quarter, with a standout 45% growth in equities trading revenue. That's not just solid. It's a strong signal that they're ready for a rebound in investment banking. Analysts believe more than $1 trillion in private equity investments have yet to be monetized. As that backlog clears, Morgan Stanley could be a major beneficiary. Pros: world-class wealth management and strong trading desk. Cons: sensitive to interest rates and capital markets activity. MS closed at $131.93, with a price target of $147. Now, for one of the most explosive names in tech, AMD. Ticker AMD. Advanced Micro Devices has been on a wild ride, up over 5,000% in the past decade, and it's not slowing down. In the first quarter, AMD posted 36% revenue growth and 476% net income growth. That's no typo. Their next-gen EPYC processors are gaining traction, and AMD has locked in the #2 position behind NVIDIA in the AI data center chip market. Pros: aggressive innovation, solid market share in CPUs and GPUs, and exposure to AI. Cons: high volatility, intense competition, and supply chain vulnerabilities. AMD closed at $121.73, with a $125 price target, but many believe that number could rise. And finally, another Wall Street giant, Goldman Sachs, ticker GS. Goldman delivered 6% revenue growth in Q1, with 15% net income growth. Their global banking and equity trading arms performed well, with equity trading up 27%. Like Morgan Stanley, Goldman is positioned to capitalize on the wave of private equity deals that have been on hold. A big second half of 2025 could be coming. Pros: strong deal pipeline, iconic brand, and wide-ranging global exposure. Cons: market sensitive and susceptible to regulatory pressures. GS closed at $613.46, with a bullish price target of $685. When we take a step back and look at the numbers, the differences between these companies become even more striking. Broadcom boasts the largest market cap at a whopping $1.2 trillion, driven by its strong presence in semiconductors and infrastructure software, yet its EPS is only $2.66, showing that despite its size, profitability per share is relatively modest, possibly due to ongoing investments in growth. In contrast, American Express, with a much smaller market cap of $205 billion, reports an impressive EPS of $14.32, suggesting a strong ability to generate shareholder value even at a lower scale. Looking at Intuit and Eli Lilly, both have high EPS numbers, $12.29 and $12.07 respectively, but the difference lies in their market valuations. Eli Lilly is sitting at a massive $750 billion valuation, whereas Intuit comes in at $213 billion, indicating a premium valuation for Lilly, likely due to investor confidence in its pharmaceutical pipeline and innovation. When it comes to margins, Eli Lilly again stands out with an 81.7% gross margin, the highest on the list, followed by ServiceNow at 78.92% and Intuit at 76.79%, showing just how efficient these companies are at turning revenue into profit. Meanwhile, Morgan Stanley surprisingly shows a 0% gross margin, which could reflect the nature of financial services reporting or varying cost structures not captured the same way as tech or pharma. In terms of dividend yield, Morgan Stanley leads the pack at 2.8%, followed by American Express at 1.0%, making them more attractive to income-focused investors. On the flip side, companies like ServiceNow and AMD offer no dividends, signaling their preference to reinvest earnings into future growth. Revenue-wise, Morgan Stanley tops the list at $107 billion, followed by American Express at $74 billion, showing the sheer scale of financial operations. But Advanced Micro Devices is also notable here, and only $90 billion in revenue. Its price-to-sales ratio stands at about 1-to-1, reflecting cautious optimism from the market, especially considering its EPS is only 1.36. Before we wrap up, here's a quick question. What do you think is the biggest factor driving the stock market right now? Hype, fundamentals, or something else entirely? Drop your take in the comments. Let's get the conversation going. And here are 3 AI stocks to buy now, and could 20 times higher. Click on this video here.